I want to start with a question. When did you last choose your car insurance? Not renew it, not switch it, but choose it. As in, you looked at what was available, you compared it against alternatives, including not having to have it at all, and decided freely that yes, this is the product I want to pay for with my money. The honest answer for most people is never, unless you're like really old. Because you can't choose not to have it. The law says you must, and the people selling it, well, they know that. They have always known that. Hey, I'm Andy, this is The Fine Print, and I've been going through the HMRC data, the FCA market studies, and parliamentary records, and the government's own statutory reports on this. What I found isn't really a scandal. Scandals get fixed. What I found is a system built piece by piece over 35 years. And I think once you see how it works, the enforcement, the tax, the reforms that weren't, the task force that changed nothing, your renewal letter is going to read very differently. It's not just required, it is enforced with the same infrastructure used to catch terrorists and track organised crime. I'm not being dramatic, let me show you. These are automatic number plate recognition cameras, or ANPR. There are approximately 11,000 of them on the UK roads. Every time your car passes one, motorway, A-road, petrol station, junction, the system reads your number plate, logs it in a national database, and automatically cross-references it against the motor insurance database to check whether you have a valid policy. 11,000 cameras reading 60 million plates every single day. Not when you're stopped, not when you look suspicious, automatically every time. And if your plate comes back uninsured, your car can be seized immediately. A third of seized vehicles are crushed, not auctioned, not sold off, just squished into blocks and destroyed. Last year, 138,000 vehicles were seized for having no insurance. That is 378 cars every single day. The penalties? £300, 6 penalty points on your license. The maximum a new driver can receive before losing their license entirely. £150 release fee, £20 per day storage, and if you can't collect within 14 days, squish. If the case goes to court, there is no maximum fine. It is unlimited. That is the enforcement architecture of a legal requirement to buy a private product. Now, I want to be clear, uninsured driving is obviously a problem that causes real harm. When an uninsured driver hits you, you deal with the Motor Insurance Bureau, that's funded by a levy on every insured policy. And it is slow and adversarial, and it is not fun. Uninsured driving has real victims. The enforcement has a rationale, at least. But that is not the whole story, because this surveillance infrastructure, 60 million reads per day, is also the state guaranteeing the customer base of a private industry. And what that industry does with that guaranteed market is the rest of this video. The Road Traffic Act 1988. It is a long piece of legislation, but one provision matters for today. You must have, at minimum, third-party car insurance to drive or keep a vehicle on a public road. Not advised, not strongly recommended, must. If you are parked on a public road and your car is uninsured, even if you never drive it, you can receive a £100 penalty notice. The car can be seized and it will likely be crushed. 35 million people in the United Kingdom are required by law to buy a specific financial product from private companies. They have no alternatives. There is no public option. There is no exception for poverty. There is no choosing not to. The government built a captive market and then decided to tax it. In 1994, the government introduced something called Insurance Premium Tax, IPT. It's a tax on insurance premiums collected by the insurer and then passed directly to HMRC. When it was introduced, the rate on car insurance was 2.5%. 2.5 pence in the pound. Barely noticeable. Then they raised it 6 times over 23 years in 97, 99, 2011, 15, 16 and 17. 2.5 became 3, 3 became 4, 4 became 6, 6 became 9.5, 9.5 became 10, and in 2017 it became 12%, where it sits today. A 380% increase on the original rate, on a product the law says you legally must have. 2/3 of UK consumers, according to the ABI's own research, have little or no knowledge of what insurance premium tax even is. They pay it every year. They just don't know it's being taken from them. So the government has constructed, hidden inside a legal requirement, an invisible tax that most people paying have never heard of. And every time the premium goes up for whatever reason, the government's take goes up automatically. Conflict of interest, maybe? HMRC collected £8.88 billion from insurance premium tax in 24 to 25. That is from HMRC's own published bulletin of July 2025. Nearly £9 billion collected from people buying products they are legally required to have. For context, that is comparable to inheritance tax. It is more than air passenger duty. The Office for Budget Responsibility, the government's own independent forecaster, projects IPT receipts will reach £10 billion a year by 2030. Over the next 6 years, the forecast is £57.8 billion from this one tax, on this one category of products that people must buy. The government has never cut in, not once in 30 years. Because here is the thing about taxing something people can't choose not to buy. Well, the revenue is really reliable. And reliable revenue doesn't get cut. Ever. Go to a comparison website. Go on, right now. Compare the market, go compare Money Supermarket, type in your details, 47 quotes appear. Competitive market, right? Look at all those choices. Look at how hard they're all fighting for your business. Well, let me show you what you're actually looking at. The top 10 car insurers in the United Kingdom control more than 75% of the entire market. 3/4 of every pound spent on car insurance goes to just 10 companies. The appearance of competition sits on top of a market that is, at its core, highly concentrated. In July 2025, Aviva completed its acquisition of Direct Line Group for £3.7 billion. Direct Line, whose brands include Churchill, Green Flag and Darwin, the combined entity now controls approximately 24% of the UK motor insurance market. Nearly a quarter. Their nearest competitor has 13%. The Competition and Markets Authority reviewed this deal. The same CMA that spent 2 full years investigating the car insurance market in 2012 and 2013 and found it, I'm quoting here, dysfunctional. The CMA cleared the Aviva Direct Line merger in phase 1. 6 weeks, no remedies, no conditions. 6 weeks. The market that was dysfunctional in 2012 is now more concentrated. The watchdog that found those problems waved through the deal that makes them structurally worse in a time it takes to renew your insurance, the comparison site you trusted. Now, for the comparison websites. Confused.com. It was the UK's first car insurance comparison site. It launched in 2001, built to help consumers find the cheapest deal. From 2001 until May 2021, 20 years, it was owned by Admiral Group. One of the UK's largest car insurers owned the platform that millions of people were using to compare car insurers. Well, they sold it. That relationship is over. But I wanted to leave that one with you for a minute. A company that wanted you to buy their insurance product was, for 20 years, running the tool that you used to decide which insurance product that you bought. Comparison sites earn money from insurers, per click, per sale. They look like consumer tools, but structurally, they are marketing infrastructure for the industry that they're supposed to be comparing. This isn't illegal, it's just worth understanding that when you feel like you're making a free, informed choice, this is what's happening. Between 2021 and late 2023, the average comprehensive car insurance premium in the United Kingdom roughly doubled. Premiums that had been sitting around £480 climbed to a peak of £995. That's from Confused.com's own price index, nearly £1,000 for a mandatory product. In the same period, equivalent premiums in Germany, France, Spain, and Italy rose by around 10%. In the UK, over 100%. That comparison is from the FCA's own published analysis. The government noticed, and the government acted. In January 2022, the Financial Conduct Authority introduced new pricing rules, the loyalty penalty ban. For years before this, insurers had been charging existing customers more than new customers for the same product. You stayed and they rewarded your loyalty by charging you more. The FCA said this must stop. New and existing customers must be offered the same price. Well, here's what happened next. Insurers could no longer use cheap new customer rates to attract switchers, so they equalized upward. Everyone now pays the higher price. Premiums rose 40% in the year after the consumer protection reform. So the rule designed to stop you from being overcharged for staying made overcharging everyone the rational strategy. Thank you, government. Oh, and then of course Direct Line got caught overcharging loyal customers anyway after the ban for at least 18 months. Their explanation, a system error in implementing the new rules. The compensation bill, £30 million. Their market cap at the time, over $2 billion. Aviva bought the company for $3.7 billion the following year. I will leave the systems error explanation to you. Before I show you the next layer of this that somehow gets even worse, a quick word about who's making this video possible. MEETV is a streaming service built specifically for people who have noticed, as I've been documenting for the last 20 minutes, that a lot of media they consume is funded by the exact same institutions being reported. MEETV is independent content. No ads from companies in this video, no algorithm designed to keep you in an outrage loop. Plus they now have a 14-day free trial. There's a link in the description and all the fine print content is posted over there too. Of the approximately 44 million motor insurance policies in the UK, around 48% are paid monthly. 21 million people. These are not primarily people who prefer the convenience of spreading the cost. The FCA's own market study published July 2025 is explicit on this point. Quote, "For many, especially those in more vulnerable groups, it is a necessity because they cannot afford to pay annually. They cannot afford the lump sum for a product the law says they must have, so they spread the cost, and the spreading of the cost costs them more." 60% of monthly payers face APRs between 20 and 30%. Almost 1 in 5 pays over 30% APR. The bad debt rate, the percentage who actually fail to pay, is less than 1%. They are charging 20 to 30% annual interest on a product with a sub 1% default risk. The FCA found that margins on premium finance range from 14 to 62% across providers. Insurers themselves average 53% margins on the finance product. That is significantly higher than the margin on the underlying insurance. In 2024, the FCA's Director of Insurance gave this the name it deserves. His exact words, "a tax on being poor." The words of the financial regulator about a product used by 21 million people to pay for something they are legally required to have. The FCA launched a formal market study in October 2024, published interim findings in July 2025, and published the final report in February 26. No APR cap, no rate limit, no requirement for interest-free payment options, which described it as a weak response. The industry called it proportionate. I want to introduce you to someone. Amy is 21. She works part-time as an office administrator. Car insurance, third-party fire and theft, not even comprehensive, costs her £100 a month. That is more than a quarter of her take-home pay. There is no train station in Amy's town. She needs her car to get to work, to shop, to see her family. She cannot afford to pay annually, so she pays monthly, which costs her more. She pays the penalty for not being able to afford the lump sum. Her words, from her interview with Citizens Advice in October 2024, "I can't really afford to buy luxuries like going for days out because it takes such a big part of my pay." Amy is not exceptional. She is representative. Citizens Advice found that in a survey of over 6,000 UK adults in October 24, that 2.6 million people in Britain do not drive because they cannot afford car insurance. That number jumped 50% in a single year. 900,000 new people cancelled their cover in 12 months. Of those worried about giving up their car, 40% said it would force them to change or give up their job. This is not primarily an inconvenience. It is economic exclusion. For many people in areas without adequate public transport, which in the UK is most of it, the inability to afford a legally mandated product means they cannot participate in the local labour market. People of colour pay on average £546 more per year than white drivers. People in deprived areas pay over £300 more, even after controlling for crime rates and collision data. If they also pay monthly, that poverty premium rises to nearly £400 extra per year. The people for whom the cost is most catastrophic pay the most for it. The system is not failing them. It is working exactly as it was built. In 2013, the Association of British Insurers, the lobby group representing Aviva, Admiral, Direct Line and the rest of them, lobbied the government to pass a law. Changes to how personal injury claims were handled. It saved the insurance industry significant money. The ABI made a promise. At a summit convened by the Prime Minister, publicly and formally, the savings from the legal changes would be passed on to consumers in lower premiums. Premiums fell briefly and then immediately rose again. So the ABI lobbied again. In 2018, Parliament passed the Civil Liability Act, the whiplash tariff reform. This time, the government's own impact assessment predicted savings of £1.1 billion per year for motorists, roughly £35 per policy. The ABI committed publicly that the savings would be passed to consumers. Leaders of major insurance companies signed this commitment. Parliament passed the law partly on this basis. The explicit case for restricting injured people's right to full compensation was that doing so would reduce your car insurance bill. What actually happened? In March 2025, His Majesty's Treasury published a statutory report. Section 11, subsection 7 of the Civil Liability Act required them to assess whether the promises were kept. Between 2021 and 2024, the reforms saved policyholders between £15 and £31 per policy. No, that's total, not per year, over 3 years total. They promised £35 per year. The government's own data says motorists got at most £10 per year, a tenth of what was promised. Meanwhile, since the whiplash reforms came into force in May 2021, motor insurers have saved £2.2 billion on injury claims. That figure is from the Association of Personal Injury Lawyers, submitted as evidence to the Ministry of Justice in December 2025. $2.2 billion saved by the industry from a reform passed on the explicit promise of passing those savings on to you. Motor injury claims fell to their lowest level on record. Road casualties went up. Car insurance premiums increased 69%. And none of this is disputed. The ABI does not dispute the savings figures. The Treasury does not dispute its own report. The numbers are what they are. People had their legal rights restricted. The industry kept the savings, and the lobby group went back to the government and asked them for the next round of reforms. And they got them. In October 2024, the Labour government launched the Motor Insurance Task Force. This was a genuine response to genuine public pressure. Premiums at record highs, 2.6 million people unable to afford to drive. A manifesto commitment to act. The task force was co-chaired by Transport Secretary Lewis Hay and Economic Secretary to the Treasury, Tulip Siddiq. Tulip Siddiq resigned in January 2025 due to a separate unrelated corruption investigation, but the task force continued. The stakeholder panel assembled to advise on the causes of spiralling car insurance prices included the Association of British Insurers, the lobby group whose members' pricing was under investigation. There was the British Insurance Brokers Association, and then citizens' advice, which and compare the market. There were no claimant lawyers on the panel, no independent legal representatives, no academics with expertise in insurance market concentrations. There was the ABI. The ABI used the platform to push for further reductions in injury compensation, beyond whiplash, into other soft tissue injuries. They called it their roadmap to tackle insurance costs. The same organisation, the same argument, the same terms, for the third time. The task force final report was published in December 2025. Improve data sharing between insurers, address credit hire costs, fix more potholes. The government's IPT forecast for 2030, £9.9 billion. Admiral's UK motor profit the same year the task force reported, over £1 billion. Return on equity, 56%. The FTSE 100 average is 15 to 20%. The system's not broken. It is working exactly as designed. The question is, designed to work for whom?